The largest rise since 1994 was made by the U.S. made the largest rise since 1994. The Federal Reserve in June, when it hiked its interest rate, increased by 75 basis points to a rate of 1.5% to 1.75%. Does this have an impact on us? As we discussed Federal Reserve interest rate hike 2022, key takeaways from federal fund rate spike. To rein in spiraling inflation without inciting a recession, the Federal Reserve raised interest rates by 0.75 percentage points. Since the Federal Reserve started utilizing the overnight funds rate as its primary tool of monetary policy in the early 1990s, the movements in June and July constitute the most rigorous consecutive action by raising the benchmark overnight borrowing rate to a range of 2.25% to 2.5%. The Fed funds rate affects various consumer products, including adjustable mortgages, auto loans, and credit cards. With the hike, the funds rate has reached its highest point since December 2018. The markets largely anticipated the move due to statements made by Fed officials since the June meeting that hinted at the increase. After Fed Chair Jerome Powell said that the data would determine the Fed's next course of action at its meeting in September, stocks rose to record highs. The significance of reducing inflation has been highlighted by central bankers, even if it means slowing the economy. Although raised interest rates affect borrowing rates, you'll later see Chair Powell still believes the economy is not in a recession. The interest rate banks charge for borrowing cash or surplus reserves is the federal funds rate. While some banks may have a surplus of cash, other banks may need short-term refinancing. The federal funds rate, established by the Federal Reserve Bank, serves as the standard baseline for commercial banks to lend to one another. The Federal Open Market Committee, which sets interest rates, warned that recent indices of spending and production had slowed in its post-meeting statement. The committee said, echoing the language of the June statement, although job increases have been substantial in recent months and the unemployment rate has remained low. Officials once more referred to inflation as elevated and blamed broader pricing pressures, in addition to supply chain difficulties, increased food and energy prices, and food and energy price increases. Do you see that red button with the word subscribe boldly written on it? Don't forget to click on it if you don't want to miss any of our videos. A mother shares how the prices have increased to nearly half of what they used to be. Despite the first quarter's negative growth and expectations for a marginally positive second quarter, Powell said he does not believe the economy is in a recession. The price hikes affected food prices, and the U.S. dollar also changed. We'll look into that shortly. The 100 basis points hike anticipated at the FOMC's most recent meeting is not as aggressive as today's Fed's decision. However, it is bolder than the more modest increases from the beginning of the year, signaling the Fed's intention to get inflation under control as quickly as possible. The U.S. dollar may change in response to changes in the federal funds rate. Interest rates normally rise across the economy when the Federal Reserve raises the federal funds rate. Foreign investors seeking better returns on bonds and interest rate securities are drawn to the higher yields, which attract investment capital. International investors exchange their local currency investments for investments denominated in U.S. dollars. The U.S. dollar benefits from a stronger exchange rate as a result. It is customary for interest rates to rise throughout the economy when the Federal Reserve raises the federal funds rate, which usually results in a stronger dollar. Foreign investors looking for higher returns on bonds and interest rate securities are attracted to the higher yields of these products. The U.S. dollar exchange rate about other currencies and changes in the Fed funds rate has historically connected pretty well. Have you seen the U.S. dollar about the Ghana cedi? It is bowing to the USD. The price of borrowing money rises when interest rates do as well. This raises the price of some products and services, such as homes and cars. Customers spend less, which lowers the demand for goods and services. When consumer demand for products and services declines, firms reduce production and fire employees, which raises the unemployment rate. Imagine daddy coming home with a letter in his hands, and he's been laid off because of an interest rate hike. Terrible, right? Generally, The economy weakens when interest rates rise, and the opposite is true when interest rates are reduced. Low home sales result from rising mortgage rates, and credit card and auto loan rates have increased in burden. While digital assets are in free fall, savers are finally getting returns that can be seen. The stock market and interest rates have an inverse relationship, but generally move in opposite directions. Generally, when the Fed lowers interest rates, the stock market rises, and when the Fed raises interest rates, the stock market falls. However, the market's response to any particular change in interest rates made by the Fed cannot be predicted. Thanks for watching. How exactly do the Feds reduce inflation? Does increasing price rates help? We recommend our video on what Federal Reserve does during inflation. How Fed Reserve Works 2022.